All right. Well, hello, everyone, and welcome to Financial Wellness for Young Lawyers, Understanding the Basics of Personal Financial Security, presented by the Texas Young Lawyers Association. Feel free to submit any questions through the Q&A chat function during the presentation. And now let me introduce our speakers for today. So we have Chase Wickenheiser. He's a financial advisor with Modus Park Associates, a DBA partner of Magnus Financial. Chase partners with clients to help them organize their current financial picture, advance their future financial goals, and motivate them to continually achieve those goals. Next speaker is Michael Tanney. He's a managing director at Magnus Financial Group. His previous professional experience includes Goldman Sachs Private Wealth Management, where he advised various Fortune 500 executives, government officials, athletes, and many more on assets greater than $10 billion. So thank you for being here, and I'll let the speakers take over from here.
Perfect. Tyler, thank you so much, and thank you TYLA for having us. We're very excited to be joining you all and helping to break down the fundamentals of financial planning. And we're going to dive in here, share our screen, and dive into a PowerPoint. But before we get started, definitely want to participate. That everyone on this call now, please participate. Right? We'd love to hear from your voice. Financial literacy can be a very intimidating conversation, and so the more back and forth, the more conversational we can make it, the better. So we encourage participation.
Thank you again for having us.
Yeah. See on my screen right now?
And there should be a Q&A section, so that's probably the best place versus raising your hand. And we'll monitor it, and we'll make sure to answer as many as we can along the way. And there are a couple of questions that we received in advance, some areas of focus. I'll just mention now that we'll address hopefully most of them during the presentation, but if there are any that we missed, please, at the end, we'll leave time for you to ask any questions you want. Of course, this is a shared call. It's not one-on-one, so try to make them less personal and more generic, and we'll do our best to answer them more generic as well. But of course, if there's any follow-up, you can always reach out to us on the information on this page, and we can help you with a one-on-one conversation with more specifics.
Perfect. So diving into it all, before we get into the actual education, quick agenda and what to expect from this call, right? We are going to cover 4 major areas that we believe in terms of when it comes to the fundamentals of financial planning, what are the best subjects to target, right? And there's a lot of different areas underneath these, but the 4 major areas we'll be focusing on are 1, the fundamentals of budgeting, why it is important to invest, how to invest, and then finally, how to protect yourself from the long term. And so each of these different areas will cover multiple topics within. Before we dive into the education, quick disclosure on exactly who we are, what our company is, and the 2 different parties and types of parties within the financial management industry.
So there are 2 major hats in the financial industry, financial advisory industry. You have the broker, which is on the right or the left side, and the independent advisor on the right side. We are independent advisors, and the reason we show this page up front is because we're not here to sell you anything. We're here to help you. And we want to be very clear about that. You're very lucky that the association has, obviously self-serving when I say lucky that we're here, but lucky that you have access to people like us and professionals that offer these types of services and can help educate you. So as an advisor, we don't sell products. We actually act as a true advisor, as a fiduciary. And on the other side of the equation are the broker-dealer model. And there's nothing wrong with a broker. There's nothing wrong with working with a big bank. A lot of us came from those places, but the compensation and the actual products allowed to be invested in are very filtered for very political and economic reasons. So it's just important to understand that the bottom line is we're here to help you, not sell you anything. We are true fiduciaries to our clients, and our job is to just give the best advice and hope for the best outcome for our clients. Oh, I could do that too next time. There we go. Perfect. Sure.
So quick, first question came in, can we get your contact information? Of course, we will follow up. There will be multiple resources that we provide after the call. So one piece of reassurance as well is that we are going to be providing a lot of resources. There should be some links within the actual slides. Don't worry about having to jot them down or trying to catch them before we move on. All the slides, a copy of them will be distributed afterwards, so you'll have a copy of everything. Perfect. Okay. Topic number 1, creating a budget. We start here because this is the foundation behind really everything, right? We have to have a good understanding of exactly what is coming in, what is coming down, so that we can identify and set goals around our savings ability. Because that's the lifeblood of all the different strategies that we're going to be talking about, right? And so when we approach budgeting, me being a former athlete in college, I looked at it as, you know, if someone ever came up to me and said, "Oh, Chase, what was the best way to get in shape?" And I said, "Oh, exercise." "Oh, it's great, duh, thank you," walk away. It's not very helpful. So when it comes to budgeting, we like to actually break down and describe the best way to think about the process of budgeting. The way we do that is breaking your expenses into two different buckets, fixed and variable, right? Fixed being those costs that aren't going to change on a monthly basis, right? Those dollar amounts that every single month we know we're going to be paying that amount, whether it's our mortgage, our rent, student loans, car payments, Wi-Fi, Netflix subscription, whatever it is.
Spotify, can't forget Spotify.
Spotify. All of a sudden, that's like an endorsement right now. Exactly. All those fixed amounts that are going to be consistent month after month. We can then write those down. And the idea being this, it helps to set more targeted goals with those variable expenses, the ones that are going to be changing on a monthly basis. So giving an exact example, using round numbers, let's say you make $10,000 a month, post-tax, everything else like that. If you wrote down your mortgage, your student loans, your car payments, everything else, your fixed was $5,000, 10 minus the 5, we now know we have this pool of $5,000 left over. That's where we start to set some goals, right? One, creating the fixed. This is a budgeting sheet that actually be provided. It's the best way to organize and write down and track all of your fixed.
1 second. I just want to, 1 second. This is pretty intimidating when you look at it fast. We'll send it to you. This is the worst part of the entire process. You know, people, going back to your comment about working out, right? The hardest part is going to the gym and actually showing up. This is kind of that thing, right? Just getting out of your bed and actually going to the gym. So this is painful, and it's, I call it my sock organizing exercise or my cleaning my room, where you know you really should do it, and there's a lot of benefit, but it's extremely painful while you're doing it. So I'm just warning you of everything we're talking about. This is the biggest burden, and it's purely a burden in your mind. It's not actually difficult. It just takes time and effort.
After that, when it comes to it, again, going back to the example, we had 10,000, we just spent 5,000 on fixed. Now we come to the pool of variable. Staying along with the metaphor of working out, variable expenses are like counting calories. It's impossible. If you actually are out here measuring a piece of grilled chicken on a scale, kudos to you, but there's very few people who can actually do that and stay diligent with that. It's the same with trying to keep yourself to $150 a month on groceries or $200 a month on restaurants. It's difficult to maintain those exact levels. So instead, right, get rid of the fixed, and then all of a sudden set a general variable pool, right? All right, overall, every other major expense, track it on a credit card, and that way you've set a variable goal. So going back to the example of 10,000, 5,000 gone. If we want to save 2,000, we know we have $3,000 a month that we want to spend on variable things, restaurants, gas, groceries. So on day 25 of the month, if you see your credit card statement saying your balance is $2,500, okay, consciously I know I have $500 left the last 5 days of the month to spend on whatever I want. Don't burden yourself trying to keep yourself to all these major little goals. You'll run yourself crazy.
So we're the opposite. Sometimes you'll hear these people, whether it's on Twitter or online or wherever you're looking, and they'll say, save $5 a day on your coffee by making it at home. We're not like that. We're actually the opposite. If that brings you a lot of value, go buy a coffee. Have a good time. Buy it every day. Buy your friend a coffee. It doesn't matter, right? Enjoy your money because it's here to be spent. Just be responsible and understand what that total comes out to be, because we're all adults and we all understand the basic concept, hopefully, of budgeting, right? The idea is you don't want to go below a certain amount because then you're negative. So spend it any way you want, and each month you'll see, maybe it's seasonal, maybe it's a family-related thing, but you'll see ebbs and flows, and you'll see, I didn't have as much fun as I thought I would, or that thing that I keep spending on, maybe I don't need it as much, and then I'd rather use it on something else. So we're less about what it specifically is going towards and more of stay happy and productive, and as you make more money in life, spend more money. None of us are robots. We want to have a good time here. We just need to be responsible and understand where we are along that process.
And again, the best way to track that variable pool is through credit cards. And so that's one of those alternative topics that we're going to want to address with. from the feedback from some people who we reached out to, credit cards and how best to improve a credit score and manage this debt was a topic that was requested, and so we wanted to take some time to allocate towards it. When it comes to credit cards and overall credit score, right? Your credit score is what lenders, a bank, a mortgage loan, a credit card, whatever it is, student loans, for example, that's your credit score is what they are going to check in order to gauge whether or not you are going to be a good investment, right? The higher your score, the more attractive you look to lenders. And
Chase, just real quick, when he says investment, what he means is that if you're the bank, let's say you're a car dealership and you're going to buy a car, so Chase is going to buy a car and I'm the car dealership. And Chase wants to buy this car and it's $40,000 and it's certified pre-owned. Everything about it's perfect. There were no issues about the car, nor even the cost. But me as the owner or the financier of this car dealership is going to offer Chase a loan. And I want that loan as the businessman because I'm going to collect both a profit on the sale of the car, hopefully maybe on the maintenance of the car, but I'm also going to get interest on the money he owes me. So my total return is going to be a lot better than just selling him the car outright. I actually don't want him to come in with cash. I'd much rather him be someone who wants to borrow money but is responsible. Because as an investment, I am going to lend him the money, and I got to make sure he pays me back. Now, the collateral is the car, but the car is going to go down in value as the loan continues to I would say not mature, but accrue. So there's a balancing act. In the beginning, it's fully collateralized, but later on, I want to make sure that Chase can actually really pay me back. So this credit history and the talk of a credit score becomes very important to that equation, because if I don't know Chase's history, I don't know if I'm going to lend him money, and that's losing potentially profit for me, but also I'm not going to blatantly just lend him money without knowing anything about him, because he could just run away and then I'm up, if he never pays me back. So this kind of history and establishing it is really important, and you can imagine how much more important it is when you're going to buy a home, right? Or you're in law school and all of a sudden you decide your child's going to go to school, right? I'm thinking really big ticket items that you want to make sure you can afford and finance correctly, because they're critical to the long-term trajectory of you or your family's lives.
Mm-hmm. These next two slides, purely a resource for you all, and again, copies of these slides will be provided afterwards. This is a breakdown on exactly the major criteria that affects our credit score. And so the ones highlighted in red are something that people who are active right now could potentially change and affect over the next couple months. So it could be a good end-of-year goal, right? One being payment history. Don't be late. Pay it off every month before that interest starts to occur. The amount owed, the gold sweet spot is you want to keep it below 30% of your credit limit. Credit limit is something that most people aren't aware of, right? So go to your credit card. See how much you're actually allowed to spend. If you have a good history with your credit card, see if they'll bump it up. Because if you can keep it below 10% or 30% of your credit limit, you'll expedite your score over a monthly basis. So said another way, if your credit limit's $10,000, try not to put a higher balance more than $3,000 on it. Length of credit history, that's just time. Short-term debt, if you're going to be making movement, opening credit cards, canceling credit cards, don't do it over a long period of time. If you're going to remodel your credit cards, do it in one foul swoop. And then the last one is what kind of debts, multiple different mortgages, cars, student loans. That's something that just happens naturally over time. It's a good reference to have and know exactly what's affecting your credit score. On a personal side as well, and purely a resource, these are the three credit bureaus that actually monitor and determine your credit score. You get one free look a year. There are links to each one here. It's a good habit. Once a year, it's like spring cleaning. Put it on the calendar. Just check the report and see, one, what your credit score is, and also what's affecting your credit score. These are government agencies. They're sometimes slow, and so not only do you have to keep yourself in check, but sometimes you have to keep them in check as well. They could have off numbers.
Do you remember that one time at one of the presentations at a law firm where we talked about this, and one of the managing partners, raised their hand kind of sheepishly and said, I just did this, and I found out that there's a car registered under my name that I don't even own. Clearly it was a mistake and he's working to fix it. But imagine if he didn't proactively do that and he went to go get another car or whatever he was financing, and they said, wait a sec, you have this debt already, I'm sorry, you're not eligible, and it totally messed up his plans. So it's a proactive thing that we encourage you to do once a year, and hopefully you find nothing, and that's great. But if you do, obviously you have to fix it and just be prepared to take some time.
And just be aware of it. Exactly. All right. Topic number 1 is checked off, budgeting, which is the foundation of it all. Any questions before we move on from that section?
Give it another maybe 30 seconds if anyone's typing anything.
How many credit cards should we hold? That's a good question, okay? In general, a good sweet spot, because we want to show diversification, is around 2 to 3. If you have more, it's not a bad thing, right? Because again, canceling the credit card hurts our score. The one thing that we want to maintain and make sure is we don't have a credit card sitting idle, right? If you have a credit card that shows a balance of 0 for 3 months, 6 months, a year, that's an anchor on our credit score. Put a Netflix subscription, something small that's a monthly charge, and that's all you need. As long as it's above 0 and below 30%, you're in the sweet spot.
Chase, we just got another one on debt, specifically student debt. And the question looks a little bit more specific to the person situation, so I'm going to be generic in my answer. Student debt it can be tricky. There are plenty of banks and other providers that are private that absolutely would love to refinance your debt for you at a lower rate. That being said, it's a little tricky right now because you have all these pauses on student debt when it's public. The one comment that I make that applies to both private and public is that if you make over approximately $130,000 a year, once you reach that roughly 130 number, your Social Security tax has already been taken care of. So you, in theory, are going to get a bump on your paycheck going forward for however long that is. If you make $200,000, it's 130 off of the 200, so a little more than, let's say, 60%. So that gets you like August-ish, right? The reason I bring this up is because a really easy, simple trick, because you've already trained yourself for the prior 6-7 months on what to spend or not spend, is take that surplus, whatever that amount is that you're now getting extra, and just apply it towards the principal. So every year you're taking the last X number of months of the year, hopefully, and you're just chipping away on principal. And it's a really simple, easy way to do it because it doesn't impact your lifestyle. Because again, the first 6 or 7 months of the year, you were fine with it. So just keep going. We have one other question, and then we'll move on to the next subject. What is a good goal for savings before you're about to go investing? And that's actually, we've 2 people.
Those are 2. Yeah, so a good savings goal and rule of thumb is generally, they say around 10% of your income, right? So doing a quick calculation, and we actually provide a tool as well afterwards that will help to break down, one, what's coming in, what's coming out, and what's your monthly intake, your monthly spend, and what your savings goal is, so you can see how on track you are. But ideally, 10 to 20% of your overall salary is a good range to be. It's a good target to set yourself to. But obviously, again, there's a lot of different variables, and that's a more personalized conversation.
We actually have one more come in that's a simple one to answer, so I'll just jump in. The question is, how do you bucket the categories, or how do you categorize your categories of spending, essentially? And the answer is that we'll give you a template that we find very helpful, but we'll have a lot of empty, I'll call them buckets underneath, so that you may say, oh, you didn't list Amazon, or it didn't fall into this category. But I do think that when you look at that spreadsheet we send you, it'll help guide you, and obviously afterwards you can always ask us a question if you want. Mm-hmm. So I think we're going to move on to why we invest now.
Mm-hmm. So why we invest. The main 2 external factors that we want to consider are, 1, money sitting versus money working, or AKA inflation versus compounding interest. Inflation, especially over the year of 2022, has been a hot button, ticket item in all of the news and everything else. And so we want to help to address and define it. So during this section of the presentation, we like to encourage participation. Please guess a little bit, but basically, to help give a better sense of the actual impact of inflation, we're going to give some actual examples. So please respond within the Q&A and everything else, but what would your guess be? Oh, Michael gave it away. He gave the answer. He gave the answer like that.
Failure.
Oh, my goodness.
Sorry, everybody.
We'll do it on the next one because there's a second one. But the answer is basically this. We'll give an analogy. I was going to ask how much a carton of milk in 1916 cost, but the answer is 9 cents. This is a representation, an actual depiction on exactly how the value of our money changes over time. 9 cents back in 1916 bought you a quart of milk. 9 cents in 1966 then bought you a glass of milk. In 2017, it bought you 7 tablespoons. In today's age, it will probably buy you the fragrance of milk. You just lean over a glass and, the idea is, though, over time, our money buys less and less. This negative force is something that people don't consciously take into account, and it's something we have to work against. That's why it's important to get our money actively working in areas that will correct with this. Real estate, houses are more expensive than they were in 1916. Salaries, people earn more than they did in 1916. Investments, et cetera, commodities, whatever it is, we need to get our money working. That's a negative force that we're constantly fighting against. Okay, second, participation. All right.
I'm sitting on my hands, everybody.
Compounding interest. So the example we like to give is this, and here's the example. If I gave everyone a penny today, so on day 1 you have a penny. On day 2, I told you that every penny you have and thereafter would double. So 1 to 2, 2 to 4, 4 to 8, 8 to 16, so on. How much money would you have after 1 month? In just pure guesses, right? Not number of pennies, but how much money would you have after 30 days?
I would actually love, if you don't mind, in the Q&A section, maybe a couple people just throw a number in there. It would be great to have.
Throw some guesses in. Let's see who can get the closest. There's a prize. I'm just joking.
Get a penny day 1. Every day it doubles for a month.
Exactly. All right, $100. Good guess.
We got one that says $3 million.
All right.
That's a big difference.
1.6 million.
Okay, now keep going. We're good here. Let's get a couple more. I don't expect 65 or however many people on the call, but at least 5 would be nice.
500,000. Good guess. Going a little bit lower. 1 million. Okay.
1,070,000.
No, that's higher. That's 1 billion.
Oh, 1 billion.
70 million. I like it. It's an aggressive answer.
It's great.
Perfect.
Okay, so we got 100 and we got 1 billion basically as our range.
Exactly. It's a good range.
What's the answer, Chase? Because I'm not going to push the button and ruin it again.
So the answer is 5.4 million, right? And so there's 2 major things to take away from this slide. One, obviously, this is a hyperbole, right? We wouldn't expect money to double every day. If anyone...
Yeah, I was going to say, if everyone ever offers you this, run away because there's some scam going on. Literally, it won't work.
They're going to the ponies. That's not real. It's not going to work. But the idea to take away from this is this. One, compounding interest is really effective. Over time, the money that you initially invest will start to earn, and then all those earnings will earn on top of themselves, and this snowball effect will happen, right? And the second thing is this as well. That day 1 to 10, it doesn't feel very good when our money goes from a penny to 2 pennies. Yay! But it's some place that every single one of us has to start, unless we sell a big company or an app or whatever else it is, right? We all have to start on day 1 with investing, and it's not going to feel very good saving $100 a month, $50 a month, whatever else it is.
It's kind of boring.
Boring. But the idea is, I would rather see everyone start day 1 in their 20s and in their 30s versus in their 40s and in their 50s. Time is one of your number 1 and strongest components. Take advantage of it. Let it start to really accumulate and grow over time.
I just want to make sure we're not missing any questions here. So I think we're good.
5.4 million, that was a good guess.
Cool. I'm just going to clear out the queue real quick so that we keep track of the new Q&A.
Perfect. Last example, just because it's an important topic, but here is it side by side. On the top, we took $1 in 1974 and we put it in the market, the S&P 500. That's invested. And then on the bottom, we put the dollar on a mattress. The effect is in 2019, that dollar that was sitting in cash is now has a value of 16 cents versus the dollar that was invested is now worth $154. That's why it's important. That dollar that was invested rode all the ebbs and flows, the Great Depression, the 2008 crash, everything, and it still became a much, much, much higher value than the dollar that was just sitting there. I hope that importance of investing comes through. Okay, number 2 done. Again, pausing after each topic. Any other major questions on budgeting, on why it's important to invest before we dive into the how to invest? How are we doing on timing?
Perfect. Yeah.
A couple seconds.
Yeah. Another about 10 seconds, and then we'll move on.
Yeah. All right, perfect. We'll dive into the next subject.
Show me the secret. Tell me how.
How do I get this compounding interest, right? So we're first going to start off with where do we actually place our money, right? Where are the vehicles, what are the accounts where I can put my money and get it to work, right? And so there's three main types of areas that we like to consider, right? There are the liquid strategies, which we like to quote on as an emergency fund, right? What is our nest egg? That's basically a savings account, right? Your cash on hand, what's sitting in the bank. Right now, a high-yield savings account is a great option for that. And the reason we like to build that up is because even though we talked about inflation being a really strong component and cash being the only area where it can negatively hurt us, we still need to have a good amount of reserves from those God forbid situations. The bursted boiler, the broken leg from a bicycle accident, whatever was the things we can't anticipate.
You're having a rough day.
It was a lot, one after the other.
Two
Things come in three, too, so I'm expecting like a coconut to fall or something from the sky.
Well, we're in New York City, so that one's going to be a rough one.
Will be, yeah, exactly. Be high up from the Empire State.
We know a lot of lawyers who may be able to help us with that one.
But the idea is, our recommendation usually is keeping 4 to 6 months of your monthly expense in cash. And it goes back to budgeting, right? Having an understanding of exactly what you need to spend on a monthly basis and keeping that number 4 to 6 months. So if God forbid something happens that we can't anticipate, we can live our lives for 4 to 6 months.
In 4 to 6 months, just to expand on that for 1 second, it doesn't mean that you can't let it drop down a little bit or can't let it go up a little bit. But as a general rule of thumb, with at least the people that we work with where we can see their bank account and we're working with them intimately, we try to treat it like a business. Just run a flat line. So ideally, once you figure out your budgeting, your savings, your extra spending that you kind of think you may need this year, maybe you're going to propose and you have to buy a ring or something like that. So the idea is 4 to 6 months is a range. It's not a science, right? It's more of an art, but it's a good amount to judge. So once you get into the right zone on your budgeting and you see how much surplus or ability you have to save, which obviously goes into the investing side, then try to treat your balance sheet or your bank account as just a flat line. It's not going to be perfect, but every couple months, if you're roughly around the same level, then you have hit what we call perfection. You are in the perfect zone and just have a good time doing it.
Mm-hmm. Quick question that came in, but I'm pretty sure we answered it, but answering a little bit further. Should you still keep money sitting for emergencies? If so, how much? So again, the 4 to 6 months we talked about. In our current market today, there are also really attractive liquidity strategies that it can offer a little bit of a higher return. The high yield savings account, for instance, what I mentioned, most of them are averaging around a 3% return right now. Good, safe place to park the money, this emergency fund bucket, right? Or looking into short-term treasury bills, the 3 months, the 6 months, the 1 year notes that the government offers, which are fairly referred to as the risk-free asset in any econ class. There are new options out there as well. But the idea is we want to have a solid pool of money, 4 to 6 months is the recommendation, of something that we can lean on and have fully liquidable. All right. Number 2, the midterm strategies. This is the money that still maintains that liquidity, right? It's fully accessible to us, but now it's exposed to the market. So any individual investment account, any brokerage account, think as simple as a Robinhood account or anything that can be opened up at Fidelity, Schwab, anything else like that. It's a general investment account, money that we want to be working in the market, but still we can pull out at any time.
And it's all taxable, right? And we'll talk about that in a second, but it's a taxable environment. So it's money that you've earned that you're not receiving any tax rebate or any advantage on. It's just surplus, and you got to do something with it.
Mm-hmm. And so giving them some time frames, because again, all the purposes of our money, it's all based on the time frame of when we need it. So that first area, 4 to 6 months, that kind of range. In the midterm, if the money is going to be needed in a year to maybe 5 years or 10 years, that's a good area to be placing in. And then in this last section is our retirement section, our long-term mentality money, right? These are your 401ks, these are your IRAs, and we're going to start to dive into the main two types, right? There are 529 accounts meant for education or HSAs meant for health and savings, but we're going to discuss right now and focus on retirement, the difference between, for instance, a traditional 401k and a Roth IRA. This is our funny analogy on how to explain the importance of a Roth IRA.
Is that you after the coconut?
That was me. Yeah, that was the third thing to fall. Yeah,
Coconut.
exactly.
Okay, I'll keep that in mind. I'll come visit you.
So still leaning on my experience as an athlete, right? If you ask, and I'm sure we have a ton of them in the chat right now, anyone who is in athletics or sports has probably battled with injuries, right? And so putting this question out there, if I went to every athlete when they first started their career, their sports career, 5th grade, 2nd grade, when they were young kids, and I said, okay, if I come to you, I'll give you one injury now, something small. It's not like I'm taking a baseball bat to a kid's leg or anything crazy like that, but something small. You recover, you're fully healed, and then thereafter, you'll have the 100% guarantee and confidence you will never get injured again. I'm talking not a broken nail. I'm talking not a little bruise, anything. You're impervious. How many athletes would take that bet? And
you can't see it, but I'm about 5'7" on my best day. Chase is like 6'6" monster, but this chair makes me feel better.
It's good.
But athletes of all sizes can sign up for this, so I'm down.
Exactly. That security, that protection, is the same thing that we like to instill and enforce or kind of describe with a Roth IRA, right? And so we'll dive into those two, but first I'm going to take him off the screen because he's scary. Okay, so quick breakdown on the difference between a Roth IRA or a Roth 401k and a traditional 401k or traditional IRA. And that Roth and traditional term are two different tax benefits that are received. So when it comes to traditional, which is the most common one, it's been around the longest, we get a tax benefit at the beginning. The money we put in is pre-tax. So said another way, I make $100,000. I put $20,000 away into this traditional account. The government will view me in that tax year as an $80,000 income earner. I went from 100, 20, I get viewed as if I make this much. Two major benefits from that. One, I could immediately make myself look like a lower income earner. That could lower my income bracket. That could save me on federal taxes, right? I mean, everyone here is in Texas, and so your major benefit of having no state income tax is a pretty good one, right? But still lowering the overall federal tax is a benefit. And then number two, that $20,000 that would have been exposed to tax. If I had actually taken that money out, probably I would be maintaining 14, 15, 16,000 of it. Instead of only keeping that $4,000 that would have gone to the government, I get to keep all of the 20, and I get to hide it away in an account and make all of it earn for me over time.
Tax deferred too.
Tax deferred.
Right. Which is the downfall, which is down the road when you go to take the money out of the traditional IRA or traditional 401k, the government then says, wait a sec, we have on our little list here that you didn't pay any tax on this money when you put it in, so it's time to pay the tax. And that's not a problem because you saved on the front end, the money grew tax-free or tax-deferred throughout, and now you have to pay. I think that's a fair trade. One thing to note is that if you in Texas are thinking later on in life that you're going to relocate to another state, and this is a little hard to tell because you don't know where you'll exactly be, but if it's not another state similar to Texas with the income tax, so let's say Florida or Nevada, if it's a state that has income tax, there may be a game to play where you save a lot more tax now and then essentially take the arbitrage later. So just keep in mind that in Texas, you're in, I'll say unique situation. There are 50 states and there are a lot of people in Texas, but take advantage of the tax situation because you can really play a good game with historically low tax rates right now.
Exactly. And then on the flip side of the coin, the Roth, right? Money is then received as a tax benefit on the back end. We put money in, it's taxed up front. But once it's in this account, it is now fully protected from tax ever again. It is tax-free growth and tax-free distributions come retirement, which is a big benefit, right? Said another way, money on average doubles every 10 years, right? Let's say I gave everyone in this room or in this chat $10,000 today.
Thank you.
Right? Yeah, it's a good gift. Most likely by the time that you got to retirement, that $10,000 would have grown to $160,000, 10 to 20, 20 to 40, 40 to 80, 80 to 160. Would you rather pay tax on the $10,000 today or all of the 160 that it's grown into, right? You get to protect that growth purely from tax. Now, again, it's not a clear-cut answer. It's not like, oh, Roth is 1,000% better than traditional. They each serve their purpose, and there's a balancing act that has to be done for every individual person. It's good to be aware of exactly the benefits of both, and there are benefits to establishing both accounts and finding that right level depending upon your situation.
One last thing that I want to add, we could spend a lot of time on this, but I just want to mention it real quick, is that there are distribution requirements on a regular IRA or 401k, because again, you got the tax benefit up front. The government says, hey, wait, Michael Chase, you didn't pay me taxes then. I need you to start paying me the taxes. I based that tax break on the idea that you're going to pay me later on a bigger number. When it comes to the Roth, there is no distribution requirement. So very often there's an ability to also have both of them in your balance sheet and use one as the last final frontier of your life, the last few years. If you need extra money for care, let's say, or health reasons, you use it from the Roth later on, and then you draw down the regular in between. So there's a lot of different planning, but going back to the compounding and the budgeting and the investing, all these things make a difference. They all add up, and they all lean on each other. So while one on its own may not be too significant, when you add them up, they become very powerful. And that's really the point of today's presentation, is to give you some nuggets of information. We don't expect you to remember everything, but if you can walk away with a couple of key points from this, you're already going to be light years ahead of where you were just 45 minutes ago.
Exactly. Any major questions on the different types of investment accounts and where to place money before we dive into what we can actually start investing in?
And just keep in mind, we have about 10 minutes left in the presentation, so if there's a question that you want to ask and you're not sure we're going to get to it, I think probably now is a great time to throw it in. So we'll give everyone a minute or so to just type any questions.
Exactly.
Someone asked, can I change my type of retirement account later on? The answer is yes, you can. Not only can you change the type of retirement account, but if you chose to do the traditional now, and then many years later, you decided, you know, that Roth idea kind of made sense to me. Maybe I want some of it in that. Do I have to put new money into it, or can I take my old money? And the answer is you can actually roll over or take existing IRA money and move it to a Roth. So just know there is some embedded flexibility. We also have one other question, annual limit. Yeah, so a Roth IRA, the question is regarding the limits of contributions. The Roth IRA and the regular IRA have the exact same limit. The Roth 401k and the regular 401k, exact same limits. In each year they change. They just got bumped up. I think it's $22,500
for the 401ks.
For 401ks for next year. And an IRA or a Roth IRA is, I believe it's $7,000.
So for the year of 2022, you're limited to $6,000 versus in 2023, they've just increased it to a contribution limit of $7,000. Now there is a catch-up. If you're over the age of 50, you're allowed to increase a little bit more and contribute a little bit more because you're closer to retirement. But that's also sometimes a big benefit that companies can allow for you because of the idea that, hey, if I have a Roth 401k option, I can now contribute more than basically by myself.
We had one other question come in about whether it makes sense to start investing before paying off debt. And it's a really personal decision, not mathematically personal, but the idea is that in a perfect world, you'd be doing all of them at the same time. If the debt is so outlandishly high, if the rates are crazy, if there's an extreme circumstance, then scratch what I'm about to say. But otherwise, the idea is if you can have a couple of horses in the race, going back to that pony comment, you're much better off, right? You're spreading your risk, but you're also spreading your reward. And if we can successfully win on all three, well, I think that's a good win. That's a good podium finish if you get all three.
I like that.
So the bottom line is they're not exclusive. There actually is a smart, strategic way to do all of them at the same time. Mm-hmm. So with the last about 5 or so minutes, we're going to just touch upon some types of investments, just to give you an idea, because I think most people, when you say investing, they think of Jim Cramer screaming on the CNBC screen. And while that's entertaining, it's not the only way to invest. So you can buy individual stocks. You can have a view on a company, and there's absolutely nothing wrong with that. Going with our sports analogy for a minute, just to give you an idea of how difficult it is, though, to make money when you buy an individual company. You have to be correct on both the buy and the sell. So there's two sides of the trade. So if you are the world's best investor and you are right half the time, and so the world's best investor is right half the time, which actually is even higher than the world's best investor, But if you're right 50% on the buy and right 50% on the sell, 0.5 times 0.5 is 0.25. So mathematically, if you're right half the time, you're only going to be right a quarter of the time on your investment. So our view is, yes, absolutely take some shots, let's go back to the ponies, right? Pick a pony, that's fine. But don't put it all there. Spread it out. Buy exchange-traded funds. Maybe look at mutual funds. Look at baskets of larger companies, not just one or two, but baskets of big indices. You can buy individual bonds, but you can also look at baskets of individual bonds. So there's a lot of different ways to look at this. There are a lot of different ways to invest. There are pros and cons to all of them. And the bottom line is 40, 50 years from now, looking back, it'll be very easy to see which specific one was the best, but none of us have that ability. So our job is to give you the highest probability of success, not guarantee success. If someone guarantees you anything in finance, you run the other way. And the best way to give yourself the opportunity of success is to have lots of different approaches and lots of different methodologies, but they're all go back to the same core, which is the budget, how much you're saving, how much you're spending, tax domicile, how you potentially put money away from employment. And it gets very complicated, and this is all overwhelming, and I appreciate that. But just know there's lots of different ways to invest. It could be as simple as just buying land. It could be buying real estate. It could be owning bars of gold. There's so many different ways to look at it.
And one thing, highlighting one of the topics that you brought up, this basket concept, right? With mutual funds and ETFs, which is that third circle there on the right-hand side. For the initial investors, or people who are just starting to get exposure, it's good to invest in individual names and everything else, but a very big component, or rather idea that Michael introduced, was diversification, right? We want to diversify ourselves across multiple different areas and streams so that we have the highest chance of success, because if we put all our eggs in one basket, that classic analogy, we're putting all our eggs in one basket, if it falls, everything's gone. We want to have multiple areas we're being exposed to. With an ETF, an exchange-traded fund, you basically buy an ETF, and the idea is the 50 stocks, the 100 stocks, the 500 stocks that are underneath this umbrella, this ETF, you immediately get exposure to, and their collective pooled average return is your return. ETFs are a very efficient way to keep costs low and get diversification. So someone who's just starting off and wants to get their feet a little wet, it's a good area to start just investigating and getting familiar with.
And one thing that's really cool about exchange-traded funds, and this is more of a democratization of investing over the years, but we can actually take views. Like our clients, we in addition to the personal needs and the personal priorities of the client, we have our own views of the world. We have our own views, macro and micro, and we can implement those views without picking individual stocks. We can actually say, in theory, there's going to be a very big move back to onshore semiconductor generation. So we, in theory, I'm not saying we're doing this or not, but we could short a whole basket of Taiwanese semiconductors if we wanted to through the ETF. I know that sounds a little bit aggressive, and maybe half of what I just said you didn't understand, but just know that ETFs or exchange-traded funds allow you to take a view on something that's very specific or something that's very vague and do it really, really inexpensively. 20 years ago, you couldn't do that. You'd have to go out and buy 50 stocks. You had to call a broker. And now you don't have to. And that leads me to actually one of the questions we got, which was just asking about just general financial advice. Like, how do you filter for someone? How do you go about finding them? How do you go about talking to them? How do you know if they're worth their salt?
Yeah. How do you choose an advisor to go with? And so
yeah, and that's important because advisors come in all shapes and sizes, and it doesn't mean they're good or bad people, but they all have different incentives. So the one thing that I would say as a general kind of like, if you're gonna, I'm gonna give you one bullet point, is work with a fiduciary professional. So when you talk to someone, say, are you a fiduciary only? That's specifically what you need to ask. I'm interested in talking. I'm interested in learning more about how you can help me. Before we spend any time together, can you please answer this question? Are you a fiduciary-only advisor? And I really hope they don't lie, but they should just say yes or no. And typically the answer is yes, which is Chase and me. If the answer is yes, there's nothing else to say. Or yes, however, I have the ability to X, Y, and Z. And then you know that the yes, whatever else they say, is a little bit convoluted, and there may be some incentives that they don't want to necessarily share. So we highly, highly recommend that you stick to the fiduciary-only track. And I can't promise you that you're going to get great advice from anyone, but at least you'll know that the advice you're getting is not coming from an economic incentive to the advisor.
Underlining that question as well, it was part of the question was, should I choose multiple advisors? The one thing along with that is when you spread out your money, yes, you're getting exposed to multiple different styles and people, but there's often a fee that's associated with working with an individual, generally a tier-based fee. So the more you have, the lower your fee goes. You splitting up your money, let's say you had $1 million. If you had $1 million with one advisor, you're going to be in this fee bracket, versus if all of a sudden you split it across 4 different ones, you just increased your fee across all 4, and now you're not as efficient as you could be, right? So trust the one, try out one, ask the question that Michael just outlined, and then stick the course and stay on them.
Among our wealthier clients, and this was at Goldman Sachs and also where we are now at Magnus, the really wealthy, and I'm not going to put a label on it or an actual number, but you can pick a number in your mind. They start to split it up, and I understand why, because there are certain people and certain professionals that have very specific niches. So maybe someone wants to have a piece of their portfolio in real estate, and they'd rather not go through the public markets. They want to own private real estate directly. So it might make sense to work through a specific advisor. It may not even be a fiduciary advisor, but they're going to them for a specific mandate. I want you to put X dollars into multifamily real estate, and I want you to be the operator. Right? Those are very specific mandates, but when you get to have extreme wealth, you can do that. Generally speaking, most people don't fall into that category, and by the time you back into all the moving parts, all the extra fees, all the paperwork, all figuring out, we call it a scavenger hunt, it's not worth the time and effort, and you're better off just keeping it clean and relatively simple. The one thing that we didn't touch upon here that was asked, and I want to make sure we address it because we just bumped up to our finish time, is for those that have children, there are a lot of planning techniques to take advantage of your children and in a good way and set them up for a really positive financial future, both from a tax perspective, from a protection perspective, and also from just a pure financial independence. And just don't lose sight that just because you may be late to investing and you may be late to compounding your money doesn't mean it has to continue for the next generation. So just know that you have a lot of power to really help people that may depend on you financially, and the sooner you start to build out a plan, the better off everyone is. Chase, was there anything else? Because we're up to about our bump here.
We're up to the end. Real quick, and again, these are just good, helpful tools, right? Diversification. This is our one analogy, and we won't dive into this, but the one area that I just want people to take away is this. When it comes to here, the 2008, right? Hopefully everyone's a little familiar with what happened, the housing market crash, everything else. Something that is sometimes a horror story and we've gotten exposure to are some worst case scenarios where people got emotional with their money. 2008 happened this year, and if you look down here at the bottom, large cap, which is the market, right, S&P 500, was down by around 38%. That's scary. If all of a sudden you look in your account and maybe almost half of it's gone, that's a scary time to be in. And people got emotional and sold a lot of money because I just don't want to see it go down anymore. That was one of the answers. If they sold down here, they're now locked in down here. And look what happened just 1 year later. That same area, the large cap, the market, then went up by 37%. Money and the way it's invested should be purposeful based on the time frame that you need it. If your money is not going to be needed till all the way out here in 2020, don't let what's happening here affect it and you get emotional and you missed out on the recovery that happens here. You can't try to time the market. No one ever can, right? So stay the course and trust the process is a very big thing that we just want to stress.
If you look at statistics, there's basically 2 out of every 3 years, the stock market, the U.S. stock market specifically, generates a positive return. And the idea is that the more you slide that timeline out, and this goes for global, the higher percent chance you have for a total positive return. And there are periods that really stink. There are periods like 1999 to 2009 where you would have lost money over 10 years in the U.S. stock market. You would have made a lot if you sold it all in 07, 08. But again, remember, you have to be right on both sides of the trade. And we're not advocating to be traders. So if you held on and you let it ride and it was a longer term bucket, you look back and you're like, wow, a whole decade I lost, there's nothing going on. But if you went international at the same time period, you would have been about 1.5 times your money. Now, that's not to say that you would have had the right amount in there versus US, right? You would have been globally diversified. But it goes back to the power of the diversification and for staying in your seat, because you just don't know when or where things will go differently. And if you stay properly diversified, not overly, but properly, and you have a plan, no matter how scary it is, you just hold on as tight as you can on that roller coaster. As long as you don't unbuckle your seatbelt, you're not going to fall out of the roller coaster. And that's the point. And very often, the biggest value that we provide clients outside of the initial planning is just making sure that they don't put their hand on the seatbelt to pop it open, because that is a natural reaction. We're all physically really or mentally really bad investors when it comes to our own money. We get very emotional. So with that, I think we're going to open it up to Q&A with the last 10 minutes.
Q&A, again, purely a resource. This is to help start thinking about financial independency. Interesting link here at the bottom. It's created by 4 Princeton alums, everything else. It's something that can help you see and get the concept of financial independency. Plug in your numbers, play around with it.
And Chase, perfect. I was going to say, let's put up just for the last, let's just leave that up. So in case anyone has any specific questions, they can always they see our contact information. So a question came up. Are robo-investors smart for people who are not good at keeping up with the market? The answer is they are phenomenal starting points. This goes back to my comment about democratization. So this is something that wasn't available to you 15, 20 years ago. So the idea that if you're not knowledgeable, you're not looking to pay attention, the numbers aren't huge, there's not a lot of sophistication in your situation, it's a great starting point. It's very low cost, and it's a great way to start. There will be a point in your life, and I can't tell you when or why, but it happens to everyone, where you need to have a human look you in the eye and tell you something's going to be okay, or you need a dedicated human to talk through some situation that's unfolding. When that happens, that's when it's time to reevaluate. And you say, okay, well, I have the cheapest tires, and they kept me safe so far. Maybe it's time I upgrade my tires. And you don't need the absolute best tires, but there's a very big gap between the cheapest and the most expensive, and a lot of them in the middle are extremely good. And that's kind of where you make that switch to the financial advisor. But that being said, going back to my original comment, the fact that you're even entertaining and that potential or doing that is tremendous. It's you going to the gym and showing up, which is the most important part.
Mm-hmm. Going back to the budgeting topic, on budgeting, you say around 10% of savings. That includes specific purposes, like for example, a house payment, college, everything else like that. Should there be a special budgeting subsection? It's a very personalized conversation. At the end of it, once you sit down, evaluate your cash flow, right? What's my fixed? What are my variable? What is my savings goal? After that, it comes down to how do I then allocate my savings goal? What areas and the ones that we outlined do we want to prioritize? Do we want to prioritize our emergency fund? Do we want to prioritize our midterm area, like for instance, for a home purchase or car purchase or something else? Do I want to prioritize my retirement? It all depends on people's personal situation. So first identify your overall savings goal and then determine exactly how you want to spread it out, but make sure to highlight each area.
I'm going to give you an example. We have, and this is, I'm going to say it's too common, but it happens enough, which when I explain it, you understand why. We work with a parent, and the parent is, let's call it 70 years old or so, and the child's in their low to mid-30s, roughly speaking. And we worked with the parent, and not only have we built their balance sheet and optimized it for taxes, but we've also had a bunch of protection mechanisms, the insurance and some other things as well. So we know with confidence that when this person, the parent, passes away, there's going to be X dollars left to the next generation because that was part of the plan, and it's tax-free, and that's part of the insurance planning. So without sharing the exact amounts, and obviously this depends on each family and the dynamics, but we get approval from the parents to maybe mention in general broad strokes that there will be an inheritance, but don't count it, right? But we know how much it is. So we can then help plan for the child and say, look, there will be an inheritance. We're not at liberty to discuss. It's not going to change your life tomorrow, so it's really just that's all we're going to say about it. But let's build up you buying the house now, and we can confidently, as the fiduciary advisor, recommend they don't put as much away in their retirement account right now. Instead, put more away into that house fund, for example, because that's going to provide the immediate benefit for them that they're seeking. And then we know 30 years later, there's going to be a decent windfall, and that could be used towards retirement instead. So we have the ability when we work with families, especially with multiple generations, to be able to piece these pieces together. Because if not, what happens often is that a parent, an uncle, an aunt, a child, a grandchild, no one talks. Money's it's a stigma, right? I think it's a society thing, and it shouldn't be. But no one really talks about it. And a lot of money is actually competing against each other for the same cause when it could be better used in different buckets for different things.
Real quick as well, and please keep those questions coming. I want to at least address this. This is one of the resources that we're going to be sending to everyone. This is a starter version, right? A smaller version, not as potentially intimidating as one of the other blown out versions, which again, we'll send to you as well. A good tool just to be able to reference coming in here, budgeting section, right? Different areas, being able to break out between fixed expenses, a lot of different areas to get your brain thinking, and variable, where at the bottom, it's then aggregated together and you can determine what is your monthly savings, total annual savings ability, right? Start to set some goals. And then at the end, you can also now see, okay, I've identified those goals. How can those goals grow over time? So put in what you're starting with, put in what are you contributing here on the top right on an annual basis, and assume a market rate, 8%, 10%, 7%, whatever it is, and see exactly if you're able to do that each year, how much will I have come age 65, age 60, age 50? Can I reach that financial independency? Everything else like that. I also won't go through all these different sections, but there's a more blown out version as well where you can actually track your income. How much am I going to pay in taxes then and actually keep? How much am I going to be able to budget? Once I have a savings goal, where should I be then investing in it? Track my assets, track my liabilities, what's my net worth, and then you can look at the compounding as well. We built both versions because we used to just have the blown out version, and some people found it intimidating. But all three resources, the copies of the slide, both Excel budgeting tools will be provided to everyone after the session.
And if you already are doing something similar, maybe you have, we saw it in one of the questions, a wealth front, or you have some other account set up, maybe it's mint.com or QuickBooks or Quicken, that's fine. I mean, it goes back to the comment of just going to the gym, right? The hardest part, the most important part is just getting to the gym. So whatever you're using, it's totally fine as long as it makes you comfortable and you're actively recording it. One other quick question that came in with relation, I mentioned inheritance, and it was specific, but I want to answer it. Depending on how you receive the money, if it's insurance, for example, proceeds, and it's tax-free to you, there's no such thing as a tax basis. It's just, here you go, I'm sorry for your loss, which in that example I was referring to. But if your parents, let's say, owned property, or let's say they owned Apple stock and they bought it for $1 and it's now worth $1 billion, and that's amazing to everyone, congratulations. When they pass away, that stock, wherever it's trading, will get reset at that cost basis. So let's just say they bought it for $1 and Apple was trading at 140. Obviously, they have a massive gain that they didn't realize. When they pass away and you acquire that stock, you acquire it at that $140 price. There are inheritance taxes to estates and to the actual value, but they're not specific to one investment. Do we have any other questions with 1 minute left, or if we hit our finish line here?
Hit the finish line answering one that was a little off from the topic and conversation, but want to just quickly address it regarding the Social Security question. If that was you who was asking, there are government agencies and areas where you can call to help address that. More than happy to reach out to us personally. We can help you to address that conversation as well, right? But don't want to dive into more specifics there, so please reach out. We'll be happy to help with that.
Yeah, please, again, I go full circle. Your access to professionals like us as part of your association is a huge value add. So take advantage. Hopefully there's something we said today that got turned a light bulb on in your head and you said, wow, I need to look at that in more detail. Whatever that is, feel free to reach out to us as a helpful resource. That's what we're here for.
Yeah.
And with that, I think we pass it back to the official host of this Zoom.
Yeah. And thank you everyone for joining.
All right, thank you, Chase and Michael, for giving us this presentation today. I think this has been really helpful. Thank you everybody for coming today for the CLE or for this program presented by the Texas Young Lawyers Association, and be on the lookout for upcoming CLEs presented by TYLA. Thank y'all.
Thank you.